Hello everyone, I am Ravi Samlat, editor for Morningstar India. Morningstar's mission is to create great products that help investors reach their financial goals. Today we have with us Dhaval Kapadia, who heads our investment management division in India. He will take us through the journey of Morningstar's managed portfolios, which completed 2 years this year. Welcome, Dhaval.
Thank you, Ravi. Pleasure to be here.
Dhaval, take us through the managed portfolio solutions that we launched in India and what is the rationale behind the same?
Sure. Just before talking about the managed portfolio solutions, maybe a little bit about some research, that was conducted over the last several decades, including, some done by Morningstar as well. Now, this research has shown that asset allocation or the decision on how much to invest in various asset classes such as equity, debt, and others is the primary driver of portfolio performance. Even more so than security selection or market timing, which a lot of investors tend to focus on. So clearly, diversification across various asset classes reduces the risk associated with investing in a single asset class, and if managed well, can improve risk-adjusted returns for investors. The investment management group within Morningstar is responsible for providing investment advisory and portfolio management solutions to investors, and typically these are provided through advisors. In India, we acquired a PMS license in late 2018 and launched our managed portfolios in around April 2019 or so. And talking about the solutions that we've launched now, we spoke a little bit earlier about the importance of asset allocation in driving portfolio performance. Keeping that in mind, the Morningstar Investment Management Group has built capabilities in constructing multi-asset solutions. That is portfolios that invest across various asset classes rather than a single asset class. Hence, our solutions are designed to help investors meet their financial goals.
How do you go about building portfolios under managed portfolios?
Sure. Yeah. That's an interesting question, right? We believe that each investor may have different goals, with varying investment horizon, and their willingness to take risk for each goal could also vary, right? So, for instance, someone planning to retire in 5 years may have a different risk appetite vis-a-vis someone retiring in 15 years, right? So therefore, we offer 4 portfolios, each suited to varying investment horizons and risk appetite, right? For instance, a balanced portfolio is suited for a horizon of 5 to 7 years and a moderate risk appetite. The growth portfolio for investors with a horizon of about 7 to 10 years and slightly above average risk appetite. And finally, the aggressive and aggressive plus portfolios, which are suited for a 10-year plus horizon and a high risk appetite, right? Now, talking about how these portfolios are constructed at a very sort of a broader or at a high level, each portfolio has defined risk limits in terms of maximum drawdowns or losses and volatility. Now, these limits help in driving the asset allocation, decision or how much to invest in each asset class, right? And once we define these risk limits for each portfolio, the next step is to define the asset classes to be included in the portfolios, right? And this is based on the available opportunity set in India. And the asset classes that are included in the portfolios include Indian equity, fixed income or debt, and international equities. Now, these are the broader asset classes, and the allocation within each is split into further buckets. For instance, Indian equity is split into large, mid, and small cap, fixed income into cash, short term, medium term, and long term based on duration and credit quality. And finally, international equity into 3 regions: US, Europe, and emerging markets.
And what is the process that you follow for deciding the asset allocation that will go into each asset class?
Sure. So we discussed earlier about the asset classes and the rationale for including them. Once the asset classes are defined, the opportunity set for the portfolios, we decide the allocation to each asset class based on its attractiveness from a risk and reward perspective, right? And why do we follow this approach? We believe that the price that one pays for the value of a security or an asset class is a key driver of performance even over long-term periods such as 5 to 10 year kind of periods as well. If I were to just take some examples out here, if you look at the period such as early 2008, when valuations were rich, this was on the back of a strong rally in Indian equities along with many other markets globally, and valuations had also increased at that point of time. But by the end of 2008, we saw markets correct by about 55 to 60% in India as well. And this was primarily, as we know, due to the global financial crisis as such. Now, after this period, investors recovered their money, so to say, after the correction in late 2008, they could recover their investments only by 2013 or 14. In other words, they had to wait for another 5 to 6 years to actually recover the investments that were made in early 2008 as such.
How often do you review the portfolio, and what are the triggers when you change the asset allocation?
Typically, in our case, the views across asset classes are reviewed on a month-on-month basis. Now, of course, the idea is not to make changes every month. And in fact, there aren't too many changes that happen, on a month-on-month basis. And that's because the process is structured in such a way that only in case there are significant changes in market levels, which might impact our views, only then would a change in the allocations get triggered, right? We've generally seen that market moves in excess of, plus minus 15 to 20% would trigger changes in our risk and return forecast for each asset class, which in turn could, result a change in the asset allocation. Again, if I were to take, an example out here, coming into 2020, we were underweight Indian equities in our portfolios as we felt, these were looking expensive. And at the onset of the pandemic in March, as we mentioned earlier, markets across the world witnessed sharp corrections. Indian equities were down by about 35 to 40%. Now, at that point of time, we believed that Indian equities were looking more attractive due to lower valuations, right? And alongside, we also felt that the pandemic may not have a significant impact on economic growth over the next 3, 5, 10 years or so, right? Based on this view, we added about 10 to 12% allocation to equities, across our portfolios.
So how do you go about actually selecting funds, and what kind of funds are included in the portfolio?
Sure, absolutely. And the way we execute our views across asset classes or the underlying investments, in other words, are essentially direct plans of mutual funds, right? And this could be a mix of active or passive funds. I mean, what a passive fund would mean, it could include, which include index funds, or it could include ETFs as well, potentially. Typically, why do we select direct plans? Obviously, the cost is lower, and there is no inherent sort of conflict of interest for us as well. Now, in terms of selecting funds for the portfolios, and before I talk about that, a little bit about the fund research team, that supports, the portfolio construction process at our end. Now, this research team is responsible for providing forward-looking ratings on funds, and these ratings are called as analyst ratings. The ratings essentially indicate the conviction of the analyst team in the fund, right? For instance, a gold-rated fund would indicate, a highest conviction in the, from an analyst perspective, in the fund's ability to outperform, benchmarks and peers over the next 3 to 5 years. Now, coming back to the portfolio construction process at our end, typically for the managed portfolios, we construct a buy list or a short list of about 50 to 60 funds from the funds that are rated by our analysts. Once we construct this buy list, from here we can conduct comprehensive qualitative and quantitative assessment of each of the funds in the buy list, right? Out here, we interact with fund managers, which we think is very important to build conviction in their views, to try and understand how their portfolios are positioned and what is their conviction with their own positioning. It also helps to understand the investing style, right? I mean, whether it's the manager style is more of a growth focus or a value focus, or is it a blend, right? And it also helps us validate the track record in terms of how the fund is performed across different market cycles. So these are some of the things that we look at when we sort of conduct like I said, a qualitative and as well as a quantitative assessment of the funds from this buy list as such. And eventually, the purpose of all of this is to pick high conviction managers for the portfolios and then assign suitable weights to them.
So thanks, Dhaval. For Morningstar, I'm Ravi. Thanks for watching.